Okay, I'm gonna sneak this little segment in with the Q&A video, and this is the review of the minutes from the last FOMC meeting. And I've highlighted just a few things. There's not a lot that I found incrementally interesting from what we've already heard from all the Fed officials talking. But let's just see what interesting things we find here. This first section is developments in financial markets and open market operations, and it's the manager of the meeting. The manager also discussed the balance sheet policy expectations because there is some thinking that by mid next year they'll stop the runoff on the balance sheet. The average of the survey responses indicated that the modal expectation regarding the timing of the end of balance sheet runoff had shifted a bit later to May 2025. These responses remain dispersed, though roughly two-thirds of respondents expected an end to the runoff in either the first or the second quarter of 2025. I sort of think that that's right. By mid of next year, I think sometime going into next year, end of first quarter, beginning of second quarter, there'll be a discussion, or we'll see at least the discussion being started about when to stop the runoff. Usage of the overnight reverse repo facility declined about 140 billion over the intermeeting period. This decline appeared to be driven primarily by the additional net Treasury bill supply in recent weeks, which made Treasury bill yields more attractive. Manager also noted that of late, the largest reverse repo participants had substantially reduced their participation at the facility, leading to a less concentrated configuration of reverse repo take-up than had been the case for some time. Over the intermeeting period, pricing in the federal funds market continued to be insensitive to day-to-day changes in the supply of reserves. Why is that important? Before we read the next sentence, for those of you who are familiar with the ample reserves regime, why is this important, or an important statement? If reserves are insensitive to if the Fed funds pricing in the Fed funds market is insensitive to changes in supply of reserves, it means that we're still in an ample reserves regime. Manager noted that this outcome was consistent with the reserves remaining abundant, and that various other indicators pointed to the same conclusion. Okay, continuing on. I don't have that much highlighted. The staff. This is the not the participants now, but the staff of the Federal Reserve. The staff provided an update on its assessment of the stability of the U.S. financial system and, on balance, continued to characterize the system's financial vulnerabilities as notable. I was attracted to that sentence, as notable. The staff judged that asset valuation pressures were elevated, with estimates of risk premiums across key markets low by historical standards. House prices remained elevated relative to fundamentals such as rents. Although the pace of decline in CRE prices slowed, that is commercial real estate, fundamentals continued to deteriorate across multiple categories. Cannot argue with asset valuations being elevated, and because of that, you have risk premiums being low by historical standards. OAS, this is the option adjusted spread, a measure of credit risk in credit debt, being very low. The equity risk premium, which is the inverse, take the inverse of the forward PE and subtract out the real 10-year Treasury, the equity risk premium is low. If you subtract out the nominal Treasury yield, I believe you get to either a zero or a negative equity risk premium, implying that participants are not getting paid to take on risk, but are actually paying to take on risk, which is sort of perverse. The staff's inflation forecast for 2024 was slightly higher than the one prepared for the previous meeting, reflecting incoming data. Thereafter, the outlook was similar to the previous projection. Kind of gives us a bit of a look ahead, because there was no summary of economic projections at this meeting, but there will be in December. That second sentence, I think, is important. The outlook was similar to the previous projection. Both total and core PCE price inflation were expected to decline further as supply and demand in labor and product markets continue to move into better balance. By 2026, total and core inflation were expected to be 2%. I don't know that we would be surprised by much after this statement on the SEP. I think this is sort of a nice look ahead to the SEP. We will see when we get to the participants. When they talk about inflation, they do say, we do expect it to be bumpy, but that does not change our mind about anything. So the last few readings that we saw, I don't think are really going to change very much. And if we listen to what the Fed officials have been saying since the last meeting, that is basically what they've been saying. So I've highlighted the first couple of paragraphs here. In their discussion of inflation developments, participants, these are the voting members now, participants continued to observe that inflation had eased substantially from its peak, although core inflation remained somewhat elevated. Almost all participants judged that, though month-to-month movements would remain volatile, incoming data generally remained consistent with inflation returning sustainable to 2%. Later on, we find that they changed their wording in the statement from greater certainty that it's moving to 2% to simply just saying it. Incoming data remained consistent with inflation returning sustainably to 2%. Participants commented that disinflationary progress had been seen across a broad range of core goods and service prices. Notably, in both the core goods and non-housing services categories, prices were now increasing at rates close to those seen during earlier periods of price stability. Many participants noted that the slowing in these components of core inflation corroborated reports received from their business contacts that firms were more reluctant to increase prices, as consumers appeared to be more price sensitive and were increasingly seeking discounts. Some participants remarked that although increases in housing service prices remain somewhat elevated, they continue to expect that these increases would slow, as the more subdued pace of rent increases faced by new tenants would eventually be reflected further in housing services. This first paragraph sounds like a group of people saying, things just don't go straight up or straight down. This is not going to go straight down. There's going to be some bumps along the way, but it's going down. To me, I read that first paragraph and they're all on board. It's going to go down. They're pointing things out. Many participants noted slowing of the components of core inflation, corroborated reports, right? With regard to the outlook for inflation, participants indicated that they remained confident that inflation was moving sustainably toward 2%. Although a couple noted the possibility that the process could take longer than previously expected. They didn't say a reverse. They feel confidence moving down. A couple saying, it might take a little bit longer. Because, you get participation marks here. You got to say something. A few participants remarked that insofar as recent robust increases in real GDP reflected favorable supply developments, the strength of economic activity was unlikely to be a source of upward inflation pressure. Bang! Punch in the face to all those people saying higher inflation is coming. Let me read that again. Insofar as recent robust increases in real GDP reflected favorable supply developments, the strength of economic activity was unlikely to be a source of upward inflation pressures. Participants cited various factors likely to put continuing downward pressure on inflation, including waning business pricing power, the committee's still restrictive monetary policy stance, and well-anchored longer-term inflation expectations. Several participants noted that nominal wage growth had continued to move down and that the wage premium available to job switchers had diminished. In addition, some participants observed that with supply and demand in the labor market being roughly in balance, and in light of recent productivity gains, wage increases were unlikely to be a source of inflationary pressure in the near future. Put them together. The increase in GDP, right here, was unlikely to be a source of upward inflation pressure. The job gains that they're seeing were unlikely to be a source of inflationary pressure. Does this sound like a Fed that, and what we read earlier, they Yeah, it's bumpy, but it's going down. Does this sound like a Fed that is concerned at this point? It sounds like a Fed that is taking a victory lap and saying, look, job done. Now we're cutting rates to the neutral rate. We don't know where the neutral rate is, but we're on our way there. Let's see what else I've highlighted. In discussing the outlook for monetary policy, participants anticipated that if the data came in about as expected, with inflation continuing to move down sustainably to 2% and the economy remaining near maximum employment, it would likely be appropriate to move gradually towards a more neutral stance of policy over time. And what are they expecting? They are expecting it to be bumpy. Nothing goes straight down, but they are expecting it to continue to go down. They don't see the economy as a source of inflationary pressure. Because if you have higher GDP, higher real GDP, it means you have higher supply, right? So they don't see that. They don't see wage inflation. And if the data keeps coming in like this, yeah, we're going to keep going. Now, you can interpret gradually to move gradually to a more neutral stance. So to me, that sounds like don't look for 50 basis point cuts, but don't look for no cuts. And right now, the market's got 2.5 cuts priced in over 8 meetings in the Fed funds futures. If we look at ZQ for October of next year, I think that is light. I think that is wrong. In discussing the position of monetary policy in response to potential changes in the balance of risks, some participants noted that the committee could pause its easing of the policy rate and hold it at a restrictive level if inflation remained elevated. I know it's only 2 letters long, if, but I'm telling you that is the biggest word in the English language. That has led to so many faulty conclusions. A, B, and C will happen if D happens. Yeah, but everything is contingent on D, isn't it? But then everyone just runs and say, oh, A, B, C is going to happen. No, you're missing those 2 letters, if. Could pause its easing of the policy rate and hold it at a restrictive level if inflation remained elevated. And some remarked that policy easing could be accelerated if the labor market turned down or economic activity faltered. In other words, they're pointing out the obvious. Hey guys, we're the ones making the decisions here, right? I mean, if inflation remains high, we could just stay here. And if the economy turns down or the labor market turns down, I mean, we could cut faster, can't we? Isn't this just saying the obvious with these statements of if? But I have seen the report of this in the media after saying the Fed is contemplating holding rates. No, they're not contemplating holding rates. They recognize the optionality that if inflation remains elevated, they have the option of not cutting. This is just a statement recognizing their optionality. Many participants observed that uncertainties concerning the level of the neutral rate of interest complicated the assessment of the degree of restrictiveness of monetary policy and, in their view, made it appropriate to reduce policy restraint gradually. I agree with that. You don't know where the neutral rate is. We know it's somewhere below where we are right now. So let's reduce the rate. We don't have to run there. That's why I didn't think that 50 basis point cut out of the gate made any sense at all. And there we had 50 basis points. The 25 made sense. 25 in December makes sense. It's somewhere below where we are. Almost every Fed official I've heard agrees with that. We don't know where it is. Well, then stop with the 50 basis points. It's okay to go 25 at a time. And even if you go into next year and you skip a meeting, 25 skip, 25 skip, 25 skip, that's 3 cuts. Well, that would be maybe even 4 cuts in 7 meetings, depending on which one you start with the skip on. If you go skip, cut, skip, cut, skip, cut, skip, then you get 3. But if you go cut, skip, cut, skip, cut, skip, you get what I'm saying, right? So I think December is in the books. I think you're going to get 25 in December and probably at a minimum 3 next year without really much going on. That's 4. The market's got 2.5 priced in. That's why I think it's wrong. Appropriate to reduce policy restraint gradually. And that was it. I don't see this as being a hawkish statement at all. I see this as being a job done statement with the caveat of, you know what? we're at a point where we have a choice. When they were raising rates, they were in a position where they probably didn't have a choice to pause or cut. They probably had to increase. And maybe in September, they probably saw their position as saying, look, we don't really have much of a choice here. We need to cut based on what they had saw at that point in time. Now they're getting to the point where it's like, hey, isn't this nice? We got a choice. We can either cut, we can increase the pace of cuts, or we can hold. We got a choice. That's a great place to be. And if the data continues to unfold as they expect, they will see it appropriate to lower policy rates. There is my dramatic reading of the FOMC minutes. I hope that made it a little bit more exciting. Let's get to the Q&A now. Okay, time for another Q&A session from Sunday's Market Outlook. And continuing on with the same format, where I will pick 4 or 5 questions that I can do a little bit of a deeper dive into. The first 2 are related. The GM move today seems way overdone, especially considering its low valuation already. Surely Trump will make significant carve-outs for the automakers, considering selling some in-the-money puts on the big move. And the second one is, would love to hear your thoughts on today's announcement that Trump intends to impose a 25% tariff on all goods coming from Canada and Mexico until the flow of drugs is stopped. Now, flow of drugs really is more of a Mexican issue. If Trump really does impose a blanket 25% tariff on Canadian imports, what can we expect as an impact to our economy on Canadian exports? All right, exports into the U.S. I know what you meant, but just so that other people are not confused by that, on Canadian exports to the U.S. And I will show you a website from StatsCan, a nice little interactive chart that allows us to look at the exports that Canada does have with the U.S., how balanced that trade is, and what the type of product is. If we think about the Canadian border, you have goods that are going in to the U.S. Some of them are pulled. In other words, there is demand in the U.S. saying, we want this stuff because we can't get it anywhere else, and they have it. Things like lumber, for example, things like electricity, for example, things like a particular grade of crude for the refinery, some of the grains, for example, some of the Alberta beef. If you move more into Ontario, you get to things like zinc, copper, nickel, lots of gold. So when we look at these things coming into the U.S., these are pulled. And then you have some things that are pushed where you have companies in Canada that make something saying, well, the big market is the U.S. That's not a very large part of what Canada and U.S. has for trade. Most of it is stuff that you would look at and you'd say, well, surely would have a carve-out for this, and surely would have a carve-out for that. It doesn't make a lot of sense. So I think the tariff threat has more to do with the border, because Canada does have quite a bit of migration from Canada into the U.S. In upper state New York illegally. Mexico being the bigger one, but Canada does have a lot. There's a lot that goes into the U.S. But drugs, not really. That's a Mexican thing. The cartels are in Mexico. They produce drugs there. Most of the drugs are flowing into the U.S. So as far as GM goes, GM does have exposure to both Canada and the U.S. The auto industry is integrated across the three countries, because since late 80s, 1988, 89, we've had free trade. And that was the deal, is that you can get cheap material out of Canada, cheap labor out of Mexico, and make cheap products for consumers so they have more money to spend on other things. That's the whole idea behind growth. And now here we are, after they've integrated themselves, and especially with a just-in-time inventory system, that makes it difficult. So GM does have the largest exposure. Trump is a wild card. We really don't know whether he's, as some people say, escalating to de-escalate, using the threat of tariffs to get the countries to do something else. And he was quite clear, your borders and the drugs. Or whether or not he's actually serious, because you cannot divorce the man from the situation, and Trump is of a certain type of personality. He is vindictive, he is petty, He is a narcissist. Keep in mind the UAW did not endorse him. There must be some punishment for that. They did not bend the knee. There must be some punishment for that. GM and Ford did not endorse him or contribute to his campaign. And he does not like Trudeau. So I don't know that he would have a problem seeing a lot of other people hurt if he could hurt one person. It's the nature of the man. You have to consider the nature of the man. So if I were thinking strategically, I'd say the probability is much less than 50% that you're going to have sweeping tariffs. You may have them here and there. But if I were thinking about Trump, I'd say the probability is far greater than 50% if he can hurt the people he wants to hurt who have not shown him the proper love. The UAW did not endorse Dear Leader. Trudeau has said some questionable things about Dear Leader. You can't have that. They must pay. They must be punished. So it's not as easy as just saying, well, what are the categories of products? How balanced is the trade? Strategically, that'll get a carve out. This will get a carve out. You can have a bunch of smart people sitting in a room from economics and trade and come up with what they would say. And then all you need is an abnormal psychologist in another room looking at Trump saying, no, he's going to do this. And I would put my money on the psychologist as what would happen. I would put my money on that person looking at the nature of the man and saying, this is what the person will do. He won't. I don't know that he gets embedded in these kind of strategic trade-offs when he has an axe to grind. And this is a big one. They didn't endorse him. If he can destroy some of those jobs and hurt this guy at the same time, I think he will. Let's look at the site, the StatsCan site. Okay, this is Statistics Canada, International Trade Explorer 2023. It's a nice interactive chart that we can use. Nice you have visualization mode, and you have table mode as well if you just prefer seeing that. So here is drop down menu, all sections, drop down menu here, United States. Here's trade in 2023, export 595 billion, that's in Canadian dollars, and import 373 billion. From a US perspective, those may seem like small numbers. 600 billion on a GDP of getting close to 30 trillion is almost nothing, but from a Canadian perspective, we're 1/10 the size. So it's a significant amount, 20% of production. That's 20%, that's 20% of the GDP of Canada. And of course, you have the offsetting imports, which bring the difference back down. But we still have a trade surplus with the U.S. Canada generally runs balanced trade for the most part, on average, balanced trade with the world, but we do have a trade surplus with the U.S. Let's have a look at what we export. We'll start with energy products. We export 166 billion of energy products. This is anything from natural gas, crude oil, electricity. And this is stuff that the U.S. demands, that they are more than happy to buy from us for the refineries that process a certain type of crude. That's Canadian crude or Mayan crude, which is from Mexico. You can't really switch over to West Texas. So those facilities were built specifically to process that. And this is a big reason why Canada doesn't really have a lot of refining capacity. This is why we import most of our gasoline, is because we do rely on the U.S. to say, okay, you guys are going to put the money in and build a refinery. We'll supply you with the oil. And the refinery says, well, that's great because we can build a refinery to that specific grade of crude. You'd think, well, should have a carve out for that, shouldn't we? Let's look at metals. Ores and non-metallic minerals. Exports 7.2 billion, import 4.6, but metals come from wherever they come from. If you don't have zinc, you don't have zinc. You're going to have to import your zinc. If you don't have copper or enough copper, you're going to have to import it. It's not a question of, well, you have to use American copper. Well, we are. all of it, and we don't have enough. We have to use American zinc. From where? Right? So, yeah, I guess you'd do a carve out for that one. Let's look at farm, fishing, and intermediate food products. We export 29 billion, import 14 billion. So you either have a particular type of fish or a particular type of beef, or you don't. A lot of the fish come more from northern waters in the Atlantic that you don't get in the southern waters. So you might say, well, that's food. That's a different thing. Let's give a carve out for food. And as you go through each category, decide which one would you put duties on. Look at motor vehicles and parts. We export 85 billion, but import 83 billion. That's pretty balanced trade overall. So we have to consider, well, why would you put a tariff on something that's balanced and fair? Tariffs are used in particular cases. Let's say that I am selling or you're selling product into my country without having facilities here. You can just ship the goods into my countries, whatever they are, and that's good. But you disallow me from sending them into your country. I can't send mine into yours. Our companies actually have to set up facilities in your countries and produce them there. Well, that's not really fair, is it? Why should I keep my borders wide open for you if you're going to block me? So I'm going to put a tariff to level the playing field, to make it more fair because you're disallowing me from doing something. There's the use of a tariff. But if I grow pineapples and you grow oranges, but you have no pineapple capacity and I have no orange capacity, it's in our best interest to say, look, we got way more pineapples than what we need, and you got way more oranges than what you need. You can't grow pineapples and we can't grow oranges, so why don't we just trade with each other? And you buy $1 billion of pineapples and I buy $1 billion of oranges. That is fair and it's balanced. Why would you ever put a tariff on that? So I'll leave this to you. The description, the link is in the description box if you want to play around with this. I think the only category that you could probably say, well, if we talk about consumer goods, maybe these are more pushed into the U.S. as opposed to pulled. 69 billion, imports 53 billion. You know, if you hit Canada with 69 billion, Canada could easily hit you on your 53 billion. You have to think about retaliation as well. And Mexico has already said that that is what they will do. And I think the incoming Mexican president probably said it quite well and quite succinctly about the drug trade. And she said, it is U.S. guns the cartel has. It's U.S. weaponry that they have. And it's U.S. demand that they're satisfying. Yet we're the ones being killed, right? So it's not as if the guns are made in Mexico and the drugs are being pushed into the U.S. and being forced onto the Americans. It's the demand that they're satisfying, and they're defending themselves with American-made guns. So her argument is, look, this is kind of a you problem. You made the guns and you created the drug addicts. So maybe clean up your own backyard. I don't think that's going to get her very far, but I think it's a good counter argument to say, you know, what do you want us to do about this? Next question, and there were a couple around the topic of regulation, which is why I chose this one. Not sure I agree that reducing costs related to adhering to regulations is disinflationary. Newly available capital can be used to improve operating efficiency, additional research and development, or simply to improve the capital structure of the business, which would get loaned out by the company's primary financial institution and other entities. Would the money previously spent adhering to regulatory burdens simply be redirected somewhere else? Well, you're only thinking about one side of the equation. Every transaction has two sides. Right? I've said this many times. If a company spends $1, somebody receives $1. So if that is my expense, this is your income. So if I can reduce my expense, I also reduce your income. If I reduce my expense, I can reduce the selling price at which I sell my products and maintain my margin, and this here reduces aggregate demand. So by your argument up here, you'd never ever witness deflation, because no matter what happened, you would say, but that money would just be spent somewhere else or used somewhere else. You'd never actually see deflation, because you're only thinking about, well, I save money. Am I not just going to spend it somewhere else? No, you may, but you've taken away somebody else's revenue. There are two types, I shouldn't say two types of regulations, but regulations have two broad types of effects. One effect is to raise costs, because the regulation is seen as protecting something, whether it's protecting the environment, protecting the air, protecting the water, or protecting the consumer. For example, we have a lot of regulation in the food industry that you must do this, you must do that. The reason is it protects the eventual consumer. We kind of like that thing in place, so that we don't have to always look at our food with suspicion, saying, I'm a little suspicious. There's no regulation here. Anybody can do this. Anybody can, supply eggs or supply milk or supply beef if you get rid of all the regulations. And are they doing it safely now? So those are regulations we kind of like. You can't have a world of no regulation, right? They do raise costs, but they are there for usually protective reasons. Whether you're protecting an environment, protecting wildlife, protecting humans, whatever the case is. And there's another type of regulation that reduces supply. Excessive regulation. You need 27 permits before you can build a pool in your backyard. Well, every permit has a cost. Every permit has a timeline. How many pools could be built if you just reduce the regulatory process to one permit that had everything in it? So there are some countries where, if you're trying, Japan is a good example, you want to start a business, the number of permits you need to start a business. So it holds down entrepreneurship. So if you get rid of these type of regulations that hold down supply, and if you increase supply, that is disinflationary, because inflation is when demand is greater than supply. If you get rid of this and you increase supply, you would then get supply, your supply moves into a position where it's greater than demand. So reducing regulation would be disinflationary on both sides. You either are removing barriers that hold back the natural flow of entrepreneurship and innovation, products and services, you would increase supply, or you are reducing costs. And if you're reducing costs and I lower my expense, I'm also lowering somebody else's income. Okay, this is a kind of a big question. What are your thoughts on the Department of Government Efficiency? Well, first, it's not really a department. I think they just really wanted to have that acronym, so called it a department, but it's not really a department. And the two people running it, on one side, there is an argument that there are too many government agencies which impede business, caused waste and redundancies. I don't think anyone would argue against that. Every government ends up bloating. If you take any democratic government and ask, is there inefficiency in government, the answer is going to be yes, there is. Could they be more efficient? Yes. It's just they're not run like a business, right? On the other side, there's an argument that this is a ploy by Elon Musk to get rid of the regulations he does not like, as there are 22 agencies investigating his companies for various reasons, some of them just absurd, like discrimination and hiring against illegals at space. My concern is that even if they decide what to cut from government and the budget, Congress has to implement it, which is a whole other story. This is a bit of a quagmire on this one. I don't know that there is a single citizen who would say, government, that is the most super efficient organization on the planet. There's nothing to cut there. They don't spend enough. I think everyone would agree that there is a lot of waste, and probably a lot of grift going on. I don't know if I want to call it straight out fraud, but a lot of grift. So just to give you an example, a fraud would be a private contractor bills the government for work that was never ever done. That happens. Grift is a politician wants a job after they're done their tour of duty because they don't get paid a lot. And they'd like to get paid a lot at one of these contractors. So they do what they can to make sure that that contractor gets that job at that inflated price. And this is probably the more common thing that goes on. Good luck getting that taken care of. You identify a contractor. You say this contractor has never been challenged for 20 years and is billing this much, and for what they're delivering, it's not worth it. Well, there's a congressperson who needs to get reelected in that district where that money is going, where those jobs are. That congressperson is going to be dead set against cutting anything that goes into their district because, of course, that is part of where they get votes from. And if there are cuts in that district, you're going to get a Democrat that's going to run in that district against a Republican. So you could say, well, let's just cut in Democrat districts, right? And if you cut in Democrat districts, you're probably going to re-entrench the Democrats in those districts. So once you get the politics involved in this kind of stuff, it can get really messy very quick. But Trump says he's not running again. They have one term and one term only. Do they really care if they don't win again, or can they do the tough decisions that need to be done? Problem with a democracy is even if you make the tough decisions that need to be made and you do the right thing for the country, the next party coming in will run on the fact that you've destroyed everything. And they'll just put everything back in place. Let me read to you an opinion piece that was in the Wall Street Journal regarding Musk and Ramaswamy's op-ed, The Doge Plan to Reform Government. This was written by the American Federation of Government Employees. The union starts off with who they are. We represent more than 800,000 government workers. More than 642 of them are veterans. I don't know what that has to do with anything. That, who cares if they're veterans? If there's waste, there's waste. Just because they're a veteran, we turn a blind eye. So a little bit of a national, national pride thing there. Hey, we're veterans. I don't argue that there's no government waste or inefficiency, or that government employees can do no wrong. Any large organization can do better, and 10,000 federal employees are fired every year for that reason. 10,000 out of 800,000. But let's be honest about where the waste, fraud, and abuse is happening. I've seen firsthand the waste resulting from for-profit private contractors milking the government for all it's worth. The U.S. spent $759 billion last year on private contractors, an increase of $33 billion from the year before. That's 3.5 times the budget of the entire EPA. These contractors work side by side with civil servants whose compensation totals only a third of that, about $271 billion annually. While the contract workforce has ballooned each year, the size of the civil service hasn't changed since 1967, even as the U.S. population nearly doubled. Then there's the estimated $1 trillion in tax the IRS fails to collect each year because of sophisticated tax evasion. The $72 billion in improper payments by Social Security last year, and the $60 billion a year in Medicare fraud as well. This is what the average honest taxpayer wants to stop. So that seems logical, right? Pointing out this $1 trillion the IRS is not collecting because of tax evasion. Social Security with $72 billion in improper payments, $60 billion from Medicare, $759 billion on private contractors that, quote, milk the system, and they do. So there probably is a lot that can be squeezed out. The union here is saying, just don't look at us. As any union would say, it's not us, it's them. Go after them. But I'm sure you could probably do with less than 800,000 civil servants. There is another reply as well. This is from the president and CEO of Planned Parenthood. I'm not going to go into that one because it's very specific to what Planned Parenthood does, and I don't think it has as much power as the first one does. Let's deal with this statement over here. A ploy by Elon Musk to get rid of regulations he does not like. Yeah, I mean, but you could say that of anybody. Almost every CEO would love to get rid of regulations they don't like. They just may not be in the position vis-a-vis where the president is to have much of an effect on that. But they hire companies that then go on to Capitol Hill and advocate on their behalf of, we need to remove this regulation, or this regulation is a problem. So you do have lobbyists that are in there that go through the senators and the congressmen, and maybe some of them contribute to their campaign, or they show the way through which their office, when they're done, can lead to a job in the private sector. All CEOs want that. Let's not single out Elon Musk for wanting to get rid of regulations he doesn't like. Every CEO wants to get rid of regulations they do not like. But as I've said on the previous screen, there are two types of regulations. One is focused on protection. The other tends to focus on lower supply. They seem to just be constraints. Now, to sort of just pick on this one here a little bit, the ones that tend to reduce supply by putting barriers in place, oftentimes these regulations are put in there by the private sector themselves. The private sector, through lobbyists, get Congress to enact regulations designed to limit the amount of new entrants in a particular field. That once you get big enough, you then say, okay, well, let's put a moat around us. What if there were regulations stopping you or slowing you down significantly from entering our industry? That the root of a lot of these regulations do come from the private sector because it erects barriers to entry. So let's not just completely blame government for all the regulation that's out there. The private sector also has a lot of responsibility to bear. For regulations that reduce supply, I guarantee you there's some large companies that are in favor of those regulations, and a whole bunch of startups that say all you're doing is stifling supply and innovation. And these large companies say, well, duh, yeah, that's the name of the game. The regulations that Musk might want to get rid of are more on the protection side rather than limiting supply. So there are regulations about the safety of your vehicle, the airbags that you have to have, you do crash tests to determine certain things, and this is all to protect the individual. Would you want them all removed? For example, full self-driving. Well, it's not full self-driving, but there is lots of evidence from independent third-party testing companies that have looked at this, because they don't publish their miles between intervention, that suggests that it's one of the least safest full self-driving or self-driving pieces of software out there in terms of the time between interventions. It must be increased on the scale of like 1,000 before it's at that level. Well, let's remove regulation for that, so a whole bunch of Tesla drivers can read a book while their car is self-driving and you're a pedestrian. How do you feel? Or you're in another vehicle, and now not only do you have to watch the road to make sure you don't hit anyone, you got to watch out for Teslas, because they might just drive right into you. Right? So there are regulations in place that are meant to protect you. So in Canada, for example, to be an electrician, you must have licenses To be a plumber, you must have licenses. To be a dentist, you must have license. To be a doctor, there are certain things that you have to have done. But that's not true in all countries. Now, if you're wiring up my house, I want to make sure it's done to regulation. Those regulations are there to protect me, and that you are certified to do this. So not all regulation I think we want to get rid of, and some regulation that companies don't like is there to protect us. Don't dump sulfur in the water. Don't dump mercury in the lakes. I think we can all agree on that. Well, Tesla has an issue in their Texas plant that they've been dumping some stuff in the river, and an employee took a video of it, and you can clearly see it's a problem. I'm sure he'd like to get rid of those regulations as well, but we have them in place. I think the opinion piece from the union makes a lot of sense. That if you're looking for the source of a lot of the grift, it's probably in those private contractors, because there is this relationship between public officials and the private sector that after you do your tour of duty here, if you're a good friend to our company, we'll be a good friend to you, whether it be a nice cushy job somewhere, a board seat or something. But that's usually what happens. Another big issue that happens is you have the regulatory agencies and you have the private sector over here. And oftentimes the regulations that are put out are written directly by the private sector, and that the regulators, after their time is done here, head to the private sector. Well, that seems to be an area where you can clean some things up. How do I rate the probability of their success? Fairly low. They're going up against a behemoth, which is government. And a very complex system where some contractor that gets money supports some congressman or some senator that has their seat. A lot of the regulations that are written by the private sector. A lot of regulations that are in place are asked for by the private sector, and a lot of them are particularly to erect barriers of entry, which you would expect any good management to do. Is, okay, now that you have this company, how do you stop other people from entering? FTX, well, we all know what happened there. But Sam Bankman-Fried wanted regulation of the industry, because now that they're that big, if you put regulation in, then that would stop people from coming in. It wasn't as if he was trying to be altruistic by saying, let's really do something good for everybody. It's let's do something good for the big players and stop the smaller players from coming in. And was actually engaged in actually writing the regulation that would be in place. So it's I think it's going to be a tough job for them. However, I will say this. You got to do something. This is ridiculous. You either have to balance that budget by cutting out a lot of costs, regardless of whether they're efficient or inefficient. So you could say, well, spending in area X is inefficient. Well, we have to reduce spending by 50%. And the other 50% would still be inefficient. But by saying we're not going to reduce any spending over here, but we're going to reduce the inefficiency by 50%, I believe this is going to be brutally hard to do. This is much easier to get done. Broad sweep cuts and whatever's left over, leave that as inefficient. Or broad sweep cuts and force them to become efficient because they have less food to eat. I think would probably be the better way. But as far as these regulations go, it is not a case where every business wants these regulations gone. There are vested interests, large vested interests, that want certain regulations to stay in place because they do keep competitors out. So it's not just going to be pushback from Congress. It's not just going to be pushback from the Senate. It's not just going to be pushback from public sector employee unions. It's going to be pushback from the private sector as well that actually wants these regulations in place. I don't think it's as easy as just saying we're going to cut $2 trillion and let us go. Everyone will cheer that on. Now get it done. I think there's your problem. Okay, the last question. I can't find it anymore. I think the person may have deleted it. Had to do with kind of, I don't want to say making fun of me, but sort of, on the sly, kind of insulting me, saying you can play your little apartment REITs for 500 years, you're not going to make the same kind of return that MicroStrategy makes. And there were a couple of comments around this statement. And I pointed out that you can't just look at return. You have to look at the risk that you took on to get that return. You have to look at the risk-adjusted return. Because contrary to what you may think, markets are not markets of return. They are markets of risk. If you manage your risk, return will take care of itself. If you abandon risk and start chasing return, you're going to have a very erratic return series. And for many of you out there right now, tell me if this looks like something that's familiar to you. You make money, right? And then you give it back. And then you'll make money again. And then you'll give it back again, and maybe you'll blow up, maybe you won't. But you have this pattern of making and giving back, and every time you start making it, you think, okay, I've got it figured out now. I'm not gonna give this back, but then you give it back. And then maybe you run out of money, you put more money in, and you argue that, well, the reason I blew up is I ran out of money because I was eventually right. You're playing a game of return, not a game of risk. If you managed your risk, you'd make money, you'd keep that money. Then you'd make money, then you'd keep that money. Then you'd make money, then you'd keep that money. So isn't it better to make this kind of return than to make this kind of return? Where you're making money and you're telling people on YouTube how they're missing out, but then you're really silent when this happens, and then this happens, and you're on YouTube telling people how they're missing out and how they'll never do what you're doing, and then this happens, and then sometimes you just get flushed out the bottom. You don't have to answer me. You don't have to leave a comment. Just ask yourself, has this been your history? If it is, it's because you're looking at the wrong thing. You're managing return and not risk. So let me show you how my little apartment REIT doesn't need to do that well to completely outperform MicroStrategy. Let's look at the historical volatility, and I took this off of IB options, the options viewer today. The historical volatility for MicroStrategy, 138%, cap rate 18%. I don't know where any of you were in the middle of the summer when I was talking about cap rate, and I just couldn't believe that it was selling at such a discount to its net asset value. I was buying shares and buying shares. I had, I think, at one point, 64,000 shares on this thing. And it ran from about mid-June is when I started collecting shares, and for a couple of weeks it just hung around the 43, and then it just for the next 3 months found its way up to 55, where I exited a significant number of shares. That's 28% in 3 months. MicroStrategy over that period of time went from 150 to 132, a loss of 12%. So you say that in 500 years I could never equal the return, but there's a 3-month period. I don't know where you were when I was promoting this, and this is the return it provided. Well, this was down 12%. Now, okay, I'm cherry picking a point in time where CapREIT did well, but then during this period of time, this is what I had exposure to. This is what this was doing during that same period of time. Let me get to the risk-adjusted part to make a point here, the most valuable point, that if you understand this, if you get this game will get a lot more profitable for you, okay? What if I said this to you? Just before I do this, let me set this up. What if I said, oh, you're working a job, making $100,000 a year, what a loser. Look at this person, they just won $50 million on the lottery. You can work your whole life and never make that much. Would you take that as a valid argument for anything? Would you look at that and go, well, that's some sound logic. What you're saying is I should be buying lottery tickets. You would dismiss that. You would say, hang on though. There are way more losers than there are winners. The risk of buying a lottery ticket is so great. I need an income. This is a lot safer. Now, there are millions of people who lose money on lottery every week. You don't see that. The millions of people who lose money on the lottery every week. There are millions of people who play this game every year and get flushed out the bottom. They lose everything because they chase return and they don't look at the risk that they're taking on. So with that in mind, this idea of, well, that's a ludicrous statement. Sure, somebody who wins 50 million has got more than I'll ever make in my lifetime working. But many people work their whole lifetime and make an income. Very few people win 50 million because it's bloody risky to do. Let's bring that same idea to equity. Sure, you can find something that goes up 600% in 3 weeks, but probably with a lot of risk. Let's see if my little apartment REIT can keep up with MicroStrategy on a risk-adjusted basis. Let's assume that you buy MicroStrategy and over the course of a year you get a 300% return and you're walking around chest puffed out like you've got it all figured out. Let's divide it by your historical volatility. You have a ratio of 2.17. It's not a sharp ratio. It's just a ratio of return to risk, right? Return to risk, 2.17. What would my little guy need to do to produce the same return per unit of risk? Because this is what the game is all about. It's not about how much return you're making. It's what are you being paid for the level of risk that you're taking on. Lottery tickets have a negative expected return simply because the probability of winning is so low. So you're actually paying to take on the risk. You're not getting paid to take on the risk. Sure, you could make $1 million if you take on a hell of a lot of risk, but when you figure out what you got paid per unit of risk, it might have been pretty pathetic. Well, since I have historical volatility of 18 and I want to get 2.17, my numerator would have to be 39 or 39%. Out of cap rate. I've already shown you in a 3-month period it has returned 28%. You may say, yeah, but you got lucky on that. No, I didn't. I know how to analyze REITs. I recognized that given its NOI growth, given its NOI growth, given the fact that interest rates are coming down, cap rates are R minus G, the G component was coming down, it had good G, and it was selling at a significant discount to net asset value. Put those things together, I said, I don't understand why it's at $43, right? And up we went. So I can, at any point in time, identify this opportunity again. And guess what? It is here again. This is the third time now that cap rate has come down to a discount to its net asset value, that I've been buying it, and it will go back up because of just the nature of the company. So I can do this on a repetitive basis, given a large enough universe of REITs, on a risk-adjusted basis, on an absolute basis for return, I can do more than 39% just by looking for these types of opportunities. On a risk-adjusted basis, I can beat you at 300%. In other words, I would be getting paid more per unit of risk than you do. So yes, my little REITs can beat MicroStrategy on a risk-adjusted basis. Now, if you think it's not risk that matters, no, it's the return. You got to make the return. Then why are you working at a job and not buying lottery tickets? And that's the end of this one.